Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. We bring you the information. You do your own research. And today's guest is the head macroeconomist of Swiss Block, an expert on business cycles and the founder of the Zeberg Report. It's Henrik Zeberg. Welcome to the show.
Thank you, Jesse.
Happy to have you on the show today. I do want to start with what appears to be a blip in the radar of a larger bull market trend in the broad market. We saw a dip of around 2 to 3% in the S&P and the NASDAQ. We saw a much bigger correction in the Nikkei, which I want to get to in just a moment. Of course, social media was on fire with people proclaiming, here we go, this is the end of overvalued tech. This whole thing's starting to crash. There was a lot of panic. There was a lot of people celebrating prematurely who were on the other side of that bet. What are your thoughts there? Was that just a blip in the radar, or was that a sign that maybe we could see more weakness up ahead?
Well, I think it's a sign we could see more weakness up ahead, but not before quite a substantial rally at what I've been calling a blow-off top. So I think what we're starting to see is that the economy is rolling over. The business cycles have been rolling over, and that is starting to show with weaknesses around the world in the economy and in the markets. So what we start to see now coming in Nikkei was actually something I had this target where we saw the top for Nikkei for quite some time, and I have not been surprised to see it actually also because we had some weakness deterioration in the market. Which actually showed that we were going to see some kind of a decline. And I think it's going to continue. I don't think it's going to continue straight down from here. So in the Nikkei, I think we've seen the top, a major top, but I don't think we are going to see it straight down. Obviously, we'll see bounces, and I think we'll be in one for now for a couple of months now, and then we'll see the rollover for real. So to answer your question, I think it's more than just a blip, and I think it's the start, the beginning of the end. But the end for the S&P will just come at much higher levels than what we have now.
So how much higher do you think we could theoretically go from here? I know you don't have a crystal ball because so many of these AI stocks and tech stocks already seem so overvalued if we just simply look at PE, for example, and many other ratios as well. How high can it really go before market participants start to exit and take profits?
Oh, I think first of all, you never know how far sentiment can take you on euphoria. So when I start to talk about now that we're going to see an end to this bull market, people are telling me, "Oh, you don't understand this, and this AI stuff is then some, the new shit. It's going to, change the world, and the Fed's got our back, and they can just do printing, so then nothing will happen, and you don't understand how this works because you're just a boomer or something." I don't know. I think what we're seeing is simply that kind of euphoria into that market top that we have seen so many times. And we were also told back in 2000 that, the internet now is a completely new thing. So that means that, valuation can go to much higher levels, and we'll not see a new decline again. And we heard that also before the financial crisis, and now we hear it once again. So I think we can go to around 6,100 to 6,000, maybe even 300. I think I've just made some updates on that. So from that, in that range, but not much higher than that. And then I think it will start a very, very strong bear market will begin, which will take us to much lower levels.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. So I want to speak briefly here about the rise in Japanese yen along with the fall in the broad market, the collapse of the Nikkei, A lot of people were pointing to the yen carry trade unwinding. This is basically borrowing yen at a very low interest rate, as the Bank of Japan has kept rates near zero for so long now, and then converting it to other currencies where you can get a higher yield. Um, do you think those things were correlated? There's a lot of talk about a lot of hedge funds are involved in the yen carry trade. They have to unwind their positions, and this could cause much more issues up ahead. What are your thoughts there?
I think it's too simple an explanation. And I think sometimes the narrative is just trying to chase the price development. And if you look at it, this decline that I was expecting was actually quite clear that we would see some kind of decline here, and actually also a market top if you look into the charts. So I think it's a narrative that just comes up, and then we have to explain with human words what is actually going on. The thing is, we have a huge bubble. We have a huge bubble based on AI, and this has also been going on in the Japanese index, and I think it's up. I can't remember. It's like 150, 160% since 2020. So it's just been going up really, fast. And when things do that, well, then you also see that you have strong declines, and especially when all this has been brought about by money printing over the years. So I think we're going to see that the quantitative or the QE world is going to take a change here, or have a change, because this about printing wealth, that has been the perception of some that you can actually do that, is going to come to haunt us. And I think Japan has done that for many years. And again, what we see now in Japan is just again, a business cycle coming to an end, with extreme values in the market, and then we have to have some kind of narrative of why it is that it starts to decline. Simple. At some point, the camel's back is going to break when the valuations are getting too frothy, and I think that's what we see simply now.
So are we going to see further downside in the Nikkei from here, perhaps a larger crash? And how do you see Japan's fate economically playing out? It's the highest debt to GDP of any country in the world. Bank of Japan has this crazy policy where they keep interest rates close to zero for such an extended period of time. They capitulated and indicated they won't be raising rates anymore after a very small rate raise recently. I see the Bank of Japan similar to a lot of central banks in that they don't really know what they're doing in the grand scheme of things. Am I off here? Is there some sort of genius behind this madness? And what is the ultimate fate of the Japanese economy and stock market in your view?
I think printing money is like, it feels good for a little while. I mean, in Danish we have something like, it's like peeing in your pants to stay warm. It really feels good for a little while, because then you stay warm, but then it starts to get really cold. And I think that is really what you see also with the Japanese central bank, and what they've been doing over the years. For a long time it has worked, and now the rest of the world in 2008 joined them on this fabulous endeavor where we can just print. Why did nobody think of that? 60 years ago, if you just turn on the printer, then you can actually create wealth. Try imagine, why did nobody think of that? And really, this is the very problem with this system that we have right now. That's also the problem in Japan. So when you start doing that, you actually encourage people and corporations to take on more debt. And that's what you have in Japan now. You have, hugely indebted, society, and also the public debt. And what you have there simply is just an elephant on wobbly feet here, because when these things are starting to come up and the rates are starting to just move up a little bit, whoa, then the whole thing collapses. So that's the problem here. That is that we have been driving this all the way out to the very end of it. And what there, I think it's Mises who said also that there is only the one end to a an economy, or to a flourishing economy brought about by credit expansion, and that is that it's going to come crashing down, either because you choose to do it, voluntarily, or actually because it comes crashing down because of it simply cannot, hold together any longer. And I think that is what we're going to see. I mean, we have extreme valuations, and in the US we have this 200% market capitalization to GDP, and in Japan it's similar, huge GDP, huge debt. And that will, of course, come to haunt. I mean, there is, it's simply ridiculous to think that we just invented something that is now called MMT, and we can just print our way out of everything. What you do is that you push up valuations to a certain limit, And then if you just do a little kind of adjustment or rates just move up a little bit, well, then it all comes tumbling down. So I think we're starting to see the end of this entire adventure, which has been going on since 89. So it's a crazy long time. And in the bigger pattern, what I see for the Japanese market, well, I hardly dare to say it, but I think we could see an 80% decline in the Nikkei. And I fear what that can bring along. So I think with the kind of crazy experiment that we've had going on for so many years, and now we start to see unravel, and actually at the very level that this same structure that calls for an 80% decline called for the top also here. Well, it's that could be a very big event unfolding in Japan, and then also of course affecting the rest of the world.
Switching back to the United States here, in the midst of this recent correction in the broad market, we saw economist Jeremy Siegel appear on CNBC calling for 275 basis point cuts up ahead. He thinks that that's going to be required to set everything right again. I mean, can rate cuts even solve the problem here? And, everybody's saying now, okay, there's basically a 100% probability that the Fed is going to cut rates up ahead. Some are saying 25 basis points. Somebody like Jeremy Siegel saying they need to do 75. Can that solve the problem? Are there consequences as well to cutting rates too rapidly from this point?
At this point, the Fed is so late that if they should cut 0.75 or more, I don't know, but they should do something about it. But the problem is we are all turning to monetary policies here. And the thing is that if you are really in debt, like what the U.S. is, and the rest of the world, you can keep it going for a little while, and you can keep cutting rates, but then again, by the end of it, you're just coming to a situation where you have to deal with it. Be a necessity to deal with it because you can only push the valuations as far. So this about coming to cut and then everything will be fine. I think also when you look at the real economy here, I have a B in here. Sorry about that. That is that when we look at the real economy here, that the real economy is driven by the consumers, and the consumers, I don't see them being very happy about now going out, and because rates are cut, then immediately jumping into it and saying, hey, let's go spend those extra $500 we save per month or per year or whatever. I mean, that is not what they think immediately, because they have been seeing inflation going high. They've seen interest rates moving up really quite quickly, and they're paying that, and they've been hurting from that, and they also fear now, as unemployment is moving up, that they can get unemployed, which means that would you actually say let's sit on those a couple of hundreds here per month and then see what happens? And if they do that, well, then QE becomes impotent, because what is required of the money there, it needs to circulate, it needs to get into the real economy. So if you save those money on your mortgage loan, then you have to take that out and say, hey, we got an extra a couple of $100 here, let's go and spend them or something, and then we'll be part of that bigger cycle, the positive feedback loop. So if the Fed can do that now, they first of all have to understand that it takes a while before. They'll probably not take as long for the financial market to see this, and the financial market will probably rejoice and say, "Oh, wow, free money again! Let's party." And I think that's what we're going to see. Actually, I think that's why we're going to have the blow off top that I'm talking about, to this 20% higher the S&P than where we are now, an extreme crypto bull market that is going to unfold as I see it. But that will be because of that. But it does not mean that the economy will then follow. And that's where I think there will be the schism between the real economy and the financial world. The financial world may think it's party time, but the real economy will simply be sluggish. And that can, down the road, a little further after the deflationary bust that I'm expecting to unfold in the next, starting in October, well, then I think later down the road, you can actually see that this can bring about a stagflation. But let's talk about that a little later. But for now, yes, the Fed should absolutely be cutting, because they need to stimulate now. They have been way too hawkish for way too long, and there's no need for it. I mean, this is the inflation is coming down strongly, so there's no need for that. I know that they'll be pointing to the CPI numbers, but they are very lacking. And also they have to understand that they need to go through the whole value chain of the economy, which means that the numbers that we see today is something that was actually produced in the economy some time back. So So the whole thinking of just looking at the CPI numbers is simply looking out the rear window while going forwards. So I think, yes, they should absolutely be cutting, and they are causing a lot of havoc already in the world with the high rates that we see in the US right now.
Let's talk about gold and the role that you see gold playing up ahead. It was one of the few asset classes that held up quite well during the correction that we had recently. Obviously, at this point, still hovering near all-time highs in nominal terms. How do you see gold performing up ahead? Do you see it as potentially the ultimate safe haven asset in this current environment? We also have the narrative out there of central banks accumulating gold at a record pace. Some are pointing to the fact that perhaps a lot of different countries are looking to gold to fill the role that US treasuries used to fill as kind of the safest asset class on their balance sheet. I'm wondering what your thoughts are on gold at the moment and how you see the gold market evolving moving forward.
So I think there's different perspectives on this, and I think on the long term perspective, we'll definitely need sound money again, because the very problem of what we have now across the world, also in Japan, is that we have been thinking that, oh, we got this free lunch, which is really we can just print money. Let's just print a lot of money and just pour it into the economy, and then everything will just sort itself out, because then you will get higher growth and everybody will be happy. That has been pushing up a lot of the valuation levels. So I think we will, on a later time basis, be need to see sound money coming back, sound monetary policy coming back, and I think when we get down to that point, it will be based on a kind of a basket of various currencies from around the world, kind of the setting up a new reserve currency, which maybe consist of more than just the US dollar, but obviously with the US dollar as the leading component in that. And their gold will be a major factor. So how much gold do you have, and you'll have a potentially an equal part in that basket. But that's one thing. That's down the road. That does not mean that gold is a good investment right now and right here. And I think if I'm right on what we're starting to see unraveling here, then there'll be a little tailwind for now, and we'll see a tailwind maybe going into October. But then I think it'll be straight headwind. And I think I have a target for the dollar, Dixie, after hitting what I think will be around 93 into, let's say, November, around that time. But then I think it's going to reach 120. And I can, if I'm right on that, into a deflationary bust, I think gold is going to not to perform very well. So I think we're going to have a strong decline there. And I think actually it's going to, it's been pushed up by expectations of gold moving higher. And I think that's why you see that gold is so high compared to silver, platinum, palladium, and so on, and even to the miners. None of those are actually supporting the level of gold. So I think we're seeing that gold will potentially actually having take a lot of a major dive there into that deflationary part of it. But down the road, again, also when the Fed enters again, I mean, gold is an absolutely must-have, and I think that's what we need to know. I mean, gold long term, yes, you must have, but can you bear those 30, 40, 50% decline you could see in gold? I mean, we saw 34% from March of 2008 until September, October of 2008, 6 months. You saw 60% decline in silver at that point, which is in the deflationary part of it. That's when there's a lack of liquidity in the system. That is where gold and silver are actually getting sold off. I think we're going to see that same situation again, because we have the same situation setting up now. We have recession signals. We have a blow off top, and we're going to see a lot of value destruction when we get into that blow off top. So I think gold short term, small bounce into that October or something like that, maybe getting closer to the top, and then we'll see a strong decline, and then it will simply be rejuvenated into Fed starts to react again and potentially set the economy on a potential stagflation path, because with the kind of stimulus that they're coming to do, and with the sluggish economy, you could potentially see a stagflation unfold.
You mentioned silver and some other metals there as well. I'm wondering how you see the commodities complex performing up ahead. Also, I had David Hunter on the show recently. He said he thinks after around 80% decline in the broad market coming within around a year, he thinks that we're going to see a commodities super cycle unlike anything anyone can imagine. He's talking about $10,000 gold, I think, $500 a barrel of oil, these sorts of what seemed like insane numbers, to be honest, even as somebody myself who's extremely bullish on the commodity sector. Do you think after we see this big correction bust, crash, whatever you want to call it, in the broad market. On the other side of that, do you expect this sort of commodity super cycle to unfold? And if so, which commodities do you think will perform the best in that scenario?
Oh, which one that will perform the best? I don't know. I have to think about that while I'm talking here. But yes, absolutely. I think we're going to see a super commodity cycle, and I do that because if you look at it, we've actually been through a 13 years, 14, 12, 4 to 14 years commodity correction, I would call it, long-term correction, where you first had a decline after the financial crisis, then you had a strong rally, but a kind of a melt up kind of thing on a lot of commodities. And then you have what I think is now going to be the C wave and the strong decline in commodities. So I was expecting during in 2022 actually to see natural gas decline to the levels that we are at and now, and I think we're going to go lower. I expect to see oil down at $10, and I expect to see a lot of commodities actually just getting crushed into this deflationary phase here, and the same goes with the precious metals. But what I say, first of all, we have now been through when we get to that point and we get to the bottom of what I think will be the deflationary bust into beginning of next year. I think yes, then the Fed will once again step in. And as I said, I think the reason for why we will see that super commodity cycle will be because of a potential stagflation. So one thing that commodity really likes is stagflation. And why should we get stagflation? Because of what I said before, if the economy will remain sluggish, because even though the monetary policy, will make it cheaper to borrow to your house for your house or whatever kind of loan that you have, and you will start to see that this money will start to circulate in the financial markets, not really getting into the real economy because people will be sitting on that money, but people will start to, the financial market will start to think, okay, where can we find yield? Do we want to invest in stocks? Not really, because we can see the demand is not there because the consumers are not spending. Do we want to spend it do we want to put them into bonds? Not at the levels I think bonds will be at that time, because I think we'll see bond yields will be coming down a lot at that point. So you'll start to think, where do you put the money then? And then you'll start to see that super cycle coming out. And I think exactly, I don't even think 10,000 is enough for gold. I think we're going to go up by a lot more than that. I think we can go up by 6, 7 times at, from a level of 2,000. So let's say maybe 15,000 of gold. I think you can see the silver at 100, 150. I think you can see oil at, I don't even know what I haven't tried to do any calculations on that. So yes, absolutely. And the same goes for anything else we look at. I think it goes also for uranium, for any commodities that you could be thinking of, will just start to from that point on. But that will also be the main driver of the stagflation. It'll be a self-propelled kind of mechanism where the speculation and where can we put all these money that comes in from the central banks into, and then you'll see that the commodity starts to move up, which will push inflation up, and then you have the stagflationary environment, which will be very, very bullish for commodities. So yeah, I think at 2 or 3 years down the road, we'll have completely different levels of for commodities than what we see today.
And do you see this being a prolonged? Oh, go ahead. Sorry.
No, but you said also which ones will be performing the best, and I tried to think of it, and I can only say that I think there will be a lot of mining companies that are doing the mining of it, because they will be potentially be a leverage play on the actual commodity. So if you see uranium miners, you'll see gold miners and all that, they will be very much enjoying that we see high prices of gold, silver, and all commodities. So I think that the miners will, for commodity, will actually be where you would be looking to find very high performance or very high rises or rallies in the price.
And do you see this as a prolonged bull cycle? Some people believe it's going to be a decade plus, or do you see this more as, the cure for high prices is high prices once we get to $15,000 gold, or however high oil is going to go, silver, et cetera, that you're then going to see things revert and the cycle changes once again. Do you see that happening on a more shorter term time basis, or do you see this as more of a prolonged trend?
So I think when this cycle gets started, it'll be difficult to do something about it. So when we have been so accustomed with when we get a deflationary bust, we just throw money at it and then it's all solved. And then we get and this is this is the regime that we've been living in for so many years, since 2008, and even before also, where we just cut rates, and then we kind of, through monetary policy, we stimulated the economy. And now we've gone to the actually end of that rope, and just, if we saw after Corona, which was completely mistaken, just threw money at it. And then we created this inflation, and where we were, wow, what could we create inflation by that? But we didn't know. And now we are, scared of what we see here. So when we get to a point where we start to see inflation moving up, and we see the economy sluggish, we have a inflationary environment, that requires real reforms. That is not just something where you can say, okay, let's do, monetary or fiscal policies, because whatever you do there will just worsen the problem. So at that point, you will need to see what I think will be a monetary reset. And I think down the road, and now we're through the deflationary bust, we through the bounce that the first will create, and then we through the stagflation when it gets worse, you'll see that inflation will be something that I think countries around the world will start to blame each other, that we are putting on each other, that the U.S. will be exporting inflation to the rest of the world because they have been pushing the dollar down, which is what I think they will do into the crisis here. So if that happens, well, you need to have a structural approach to that. And the only structural approach that you can take is that you create a sound monetary system again. So we are talking about, the Bretton Woods kind of, approach that we saw after the Second World War in 1944. I think that is the kind of thing we're going to see again. This time around, it may have a digital or a crypto component to it. I think, central banks, digital currencies is going to come, and I think it's going to be part of that monetary reset. And I think gold will have a stake to play there as well. So I think there's going to be another, the reserve currency status of the U.S. dollar will not be challenged like that, but it's going to be reformed as a necessity and as a response to what we see in the coming stagflationary environment. And remember, I'm first saying deflation and then stagflation later on, because you don't get stagflation immediately. You get that down the road.
And so if we're looking on the other side of this, and commodities are set to perform very well after quite a large decline, you said $10 oil, which is shocking to think about. I think that would be a fantastic buying opportunity. What are the best assets in your mind to be holding going into this scenario? Gold, you said, is going to fall by quite a lot. Bonds, you said it seemed that you weren't too bullish on holding either. However, if rates are falling, there could be an argument for holding longer duration treasuries or something like that, because they could appreciate in value. What are the best assets to be holding as we go into this scenario that you see unfolding?
So this is where there is as I see it, a three-phase, let's say even call it four phases now, right? So if we say now until October, where I think we'll have the market top, I think it's all bullish on risk assets, U.S. risk assets, by the way, and especially small caps and crypto, Bitcoin. I think that is going to perform really well into that time frame. But that's a time frame that is now running out. I know that people will be most euphoric and bullish right at the moment where we get to the top. They are not there yet right now, but we will be there. And with the kind of, I think we'll get a 6.2 trillion kind of crypto market. I can promise you there will be a lot of happiness and a lot of euphoria there. And I'll be told that I'm just a boomer yet again. But I think when we then get on the other side of that, and even now you start to see that the ratio between SPX and TLT has actually shifted, which means that now it seems like on the large caps, you can actually see an underperformance versus the TLT, not against the small caps, but against the large cap. And I think that that's what we're going to see in the next phase. So coming after that top, I think there'll be a good chance for bonds actually to perform well into the deflationary bust of it. And I think the dollar will rise a lot. So going from the Dixie 93 to 120 on the Dixie, that will be felt really, really hard from in other currencies, the Brazilian real or whatever, all these. There will be a lot of currencies out there really taking the heat from that, and even also with the euro and others, they will see that the dollar will just crush everything. So that's why in that phase, it's about risk off. It's TLTs, it's bonds, it's German bonds, maybe also U.S. government bonds, and it'll be about long the dollar. Coming after that, when the Fed then steps in, because they will, obviously. I mean, they'll not let this fall, so they will step in at a certain point. Then I think there'll be a long pulse actually, or the long rally in the markets. We could see risk asset again rise for 6 months or so, and everybody will think, oh, that's the bottom, because the Fed stepped in like they did the last time, and everybody will rejoice. What I think then will be the situation is that you will not see in unemployment coming down as we expected and hoped for, which then will trigger the stagflation. And in stagflation, then it will be about gold, silver, miners, and the whole commodity play. So it'll be a very, very difficult whiplash kind of scenario environment that we'll have to navigate in. And I think it'll be very difficult for an ordinary trader, ordinary person, consumer to actually understand what is going on here. And I think it's going to cause also a lot of political damage to the system, because people will start to see in the stagflation that the pension funds are, they're starting to or the pension will start to see lower levels on their pension funds, and they will also have they'll lose their jobs and so on. If you see all these things, and prices still at the same time rise, well, then people will become a little not so happy with that situation. So I think that can cause some political fallouts as well.
And I'm wondering how you see emerging markets, what role they will play, and China as well, maybe kind of as a separate question. Do you see there being opportunity outside of US markets in places like emerging markets? And China specifically, we're seeing a lot of bearish headlines that the economy is on the brink of collapse. Obviously, the real estate crisis there is certainly an issue. You have some people on the other side of that coin, people like Louis Gove, who say actually China's doing much better than it's being portrayed. I personally see the market as uninvestable for me just because of the level of government intervention that happens. So I'm wondering what your thoughts are on emerging markets and then China specifically.
I think again it's about the timeline here. So I think there can be a good rally in emerging markets here, maybe and also in China for the next few months here until October. But I think when the whole starts, when we see the top in the US markets as well, and the dollar starts to strengthen, then I think you will see that the China and the emerging markets will have a lot of problems. And I think we're going to have a big crisis in the emerging markets. And I think we're going to have that in China as well, because again, like what we talked about with Japan and with the US and all, also, if there's anybody that has also been using debt and trying to create an artificial boom through the real estate sector, well, that is China. So it's nice and fine that you've been building all these residential areas or houses, and but somebody needs to live there, and somebody needs to be able to move into them and create a return. Otherwise, you could just have dug a hole in the ground and then fill it up again. That would have cost the same kind of return. So that is why I think if it's been moving too fast, and it seems like it has, then I think that's going to have some ramifications at a later stage. But that will be very tough at the moment. When the dollar starts to strengthen, the financial conditions will become worse, much worse, and the credit crisis and the financial crisis I think we're going to see. And then you absolutely will see also that China will have a lot of problems there. So I don't think in that time frame it will be something I want to invest in. What happens then, when we go through all of this and we come out of, and we are probably at 27 at that time, 2027. Well, then maybe I think that that we could be a place where emerging markets and China could be in some place to invest again, but that would be a completely different price levels than what we see today.
Is the traditional 60/40 portfolio dead? We've obviously seen a lot of people say driven by low interest rates, the whole mindset of set it and forget it, just put your money into an S&P index fund, maybe a bond fund, maybe a little bit of emerging markets or non-US exposure if you're feeling adventurous, and kind of call it a day and just sit back. You're going to get a compound annual rate of whatever between 7 and 9%, and just, don't worry about it. Go on vacation. Who cares? Is this going to continue? The narrative is historically, if you look at the stock market, even, as long as your time horizon is long enough, you're going to be fine in the end. Is that still the case today, or are we seeing kind of a new shift in the kind of the market environment that maybe that won't work as well as it used to?
I don't think it's dead. I think it'll be coming back again. But the environment that we'll have the coming years will not favor that kind of setup. So I think again into the top we see here in this year, I think that'll be fine because you can actually see both bonds and equities go up. So you'll have a good time in that. Then in the next phase, you'll probably see that your equities, the 60% of your portfolio, will probably have a tough time in the deflationary phase, and it could go down by 35%, 40%, maybe more, depending on what kind of stocks you're in. And you still see that your bonds will do quite well because they will still see a deflationary phase. But in the stagflationary phase that I'm talking about, both these asset classes will be declining, like what we saw in, I think it was 9 months during just after Corona, the stimulus came out, where you actually saw because inflation was moving up, and you saw also that yes, because of inflation, you saw both stocks and bonds taking a hit. And a lot of pension funds actually around the world, especially also here in Denmark, we saw just taking a huge hit because they were doing this 60-40 and will be fine. And they just managed through 9 months. But now extend that to, let's say, 20 months. Well, then it's going to be a big hit. And I think that is what we're going to see a lot of pension funds are actually going to suffer from because they just had this, it's such a simple world. Either you have inflation or you have deflation. And stagflation, that's something of the 70s. Don't talk about that any longer. But if I'm right on that, you're going to see that particular model will not do well there. And actually, you can lose a lot of money in that scenario. And that's why, exactly as I say, I think people will be looking at their pension funds and say, well, wow, was that really what we have been saving a whole life for? And now it's just out the drain. And that can cause some problems down the road. So I think it's not dead because I think it'll come back again after all of this. But there's no one model that works through the entirety of history. And if you went through that, if you went through the 70s with that kind of investment wealth, you would also see that you got lost a lot of money. So, and that environment could be coming back. The stagflationary environment, I think, will be coming back. First deflation, then stagflation.
Well, Henrik, this has been a fantastic conversation. So much great insight shared on your part. Could you tell us about your work at Swissblock, where people can find that, as well as the Zeberg report, what it is you do there and how people can subscribe?
So at Swissblock, I'm the head macroeconomist, and what we do there is we work with the business cycle. First of all, that's what I do. We then tie that up through the whole macro fund that we run, and then yes, we then try to beat the markets, and I think we're doing quite well there. We have some very good models also working on how to the signals coming for the crypto market, and that is where that's where what we do that with at Swissblock. So. And then the Zeberg report, well, it's also the work that what I have that with this business cycle and my Elliott wave models, that is the foundation for everything I forecast here, and the way I look at the markets, and that's what we do. So you can find more about that on at Henrik Zeberg on X, or Twitter, as I still want to call it.
Okay, great. Well, I'll put a link to your X account, Twitter account. We'll also link to Swissblock and the Zeberg report website, so people can also get there directly if they want to check it out. Thank you once again, Henrik. Really appreciate you coming on and sharing your knowledge with the audience.
Thank you for having me on, Jesse.
And thank you for joining us today. As a reminder, this episode is sponsored by ARC, silver, gold, osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.